You know, the absolute most powerful force in wealth building isn't some highly guarded day trading strategy, and it definitely isn't predicting the next big tech trend. It's actually the sheer, unsexy mathematical power of compounding over time. So today, we're going to fundamentally reframe your financial expectations. We're going to prove exactly why the exhausting, slow grind of boring investing is, in reality, an absolutely unstoppable mathematical force.
Okay, let's be real for a second and dive right into the frustration you feel when you do everything right. You've been saving religiously for a couple of years, automatically putting away a few $100s a month like clockwork. But then you log in, look at your balance, and it just barely moves. You run the math in your head, and it genuinely feels like it's going to take you 100 years to become a millionaire. And right at that moment, you see some guy online bragging about making 50 grand flipping an obscure crypto token overnight, and you are immediately tempted to abandon your boring index funds and just bet it all.
All right, let's get into Section 1, the expectation versus reality. Now, to really wrap our heads around how massive, mind-bending growth actually occurs, we need to look way outside the world of finance and examine the history of planet Earth. There's this concept called the Milankovitch Ice Age theory, and it completely changes how we think about extreme results. Scientists used to think it took unimaginable cataclysmic global winters to freeze entire continents. But Milankovitch proved that ice ages weren't caused by brutally cold winters at all. Actually, it was a remarkably boring cycle. A slightly cooler summer simply meant that the leftover snow didn't fully melt. Then, the next winter, new snow compounded right on top of that old snow. That new ice layer reflected more sunlight back into space, which cooled the planet just a tiny bit more. And that inevitably led to even more snow the following year.
And you know what? That invisible, honestly kind of boring cycle is the ultimate definition of compounding. It's when a little bit of growth serves as the absolute fuel for future growth, turning a remarkably small starting base into extraordinary results. The problem is, our human brains are totally hardwired for linear thinking, so we really struggle with exponential math. Think about it. If I ask you what 8 plus 8 plus 8 is, you know it instantly. But if I ask you what 8 times 8 times 8 times 8 times 8 is, your brain probably short-circuits. But if you let a tiny base compound exactly like that leftover snow, it creates results that completely defy human logic.
Which brings us to Section 2, the confounding math.
Let's see how this builds when we apply it to arguably the most famous investor in history, Warren Buffett. People write countless books about his amazing stock-picking skills, but they almost completely miss his absolute secret weapon. Out of his roughly $84 billion fortune, over $81 billion of it came after his 65th birthday. Just think about that. The vast, overwhelming majority of the greatest fortune ever built in the stock market was generated after the traditional age of retirement.
Let's do a quick thought experiment. What if Buffett had lived a totally normal youth, with, say, $25,000 saved up by age 30, achieved his exact same incredible investment returns, but then decided to quit investing at age 60 to just go play golf? Well, he would have 99.9% less money. He'd be sitting on about $11.9 million instead of $84 billion. This proves without a shadow of a doubt that his absolute secret weapon isn't just his skill, it is time.
So let's talk about Section 3, the brutal cost of waiting. To capture that kind of compounding magic for yourself, you have to survive the urge to sit around and wait for the perfect moment. Let's look at Smart Sally and Dumb Dan to really understand the sheer mathematical brutality of waiting on the sidelines. Smart Sally gets an early start at age 35. She invests a modest $200 a month into totally boring investments for exactly 10 years, and then she completely stops adding money. Dumb Dan, on the other hand, waits for the absolute perfect plan. He debates the state of the economy all through his 30s, totally panics at age 45, and then tries to play catch-up by investing twice as much money for twice as long. So, $200 a month for 20 solid years. Now here's the kicker. Despite working literally twice as hard and investing way more money out of his own pocket, Dan finishes with $60,000 less than Sally at age 65. Why? Simply because getting started today with an 85% perfect system is always going to beat endlessly researching a flawless one. Sally captured that whole Ice Age effect. Dan paid a massive real-world price for his hesitation. Moving right along to Section 4, surviving the market noise. The reason so many people completely fail to reach this 10-year mark is that financial media, and honestly our own brains, constantly seduce us into trying to find the needle in the haystack. The graveyard of Wall Street is filled with the corpses of people who tried to be just a little too smart. They fell prey to these hyped-up, data-mined formulas that promised minimal risk, but then completely imploded when tested with real money.
Take the Foolish Four in the 90s. It told people to put 40% of their money into a single struggling Dow stock, and it severely underperformed. Or the people who bought internet stocks in 1999 at prices utterly disconnected from reality, only to lose 90%? Even automated mutual funds built on supposedly flawless data from the book What Works on Wall Street launched, sucked in millions of dollars, and then immediately collapsed against the boring market average.
Look, academic finance is always looking for the mathematically perfect spreadsheet, but you are an emotional human being. Even Harry Markowitz, the guy who literally won the Nobel Prize for inventing modern portfolio theory, didn't use his own award-winning formulas for his retirement. He actually used a wildly unoptimized 50-50 split of stocks and bonds. Why? Because it proves that in the real world, you don't want a mathematically perfect spreadsheet. You want a reasonable strategy that minimizes your future regret and maximizes how well you sleep at night.
This naturally leads us to Section 5, getting wealthy versus staying wealthy.
To survive your first 10 years, you have got to master the stark difference between getting money, which requires optimism and taking risks, and keeping money, which honestly requires a healthy dose of paranoia. Consider the 1929 stock market crash. The legendary trader Jesse Livermore brilliantly bet against the market and made $3 billion in a single week. Meanwhile, Abraham Jermansky, a millionaire real estate developer, bet long and was entirely wiped out. But here's the twist. Just 4 years later, a wildly overconfident Livermore took reckless bets and lost his entire $3 billion fortune. Both of these men were undeniably brilliant at acquiring wealth, but they shared the exact same fatal character flaw. They were entirely incapable of staying wealthy because they just didn't understand survival.
So, to be financially unbreakable, you must build a massive margin of safety into your life. You have to hold boring, uninvested cash in a bank account. And no, it's not for the completely negligible 1% interest. You do it because it buys you the psychological armor you need to endure brutal recessions without selling your stocks in pure desperation. You stockpile cash to protect yourself from life's inevitable disasters, so your compounding engine never ever gets interrupted.
The truly intelligent investor also trains their brain to completely redefine market volatility. When the market drops 20%, your brain's fear center instantly tells you that you're being punished. But a market drop is not a fine punishing a mistake, like a parking ticket. It's simply the required admission fee, like buying a ticket to a theme park, to access the greatest wealth-building machine ever created. Sure, you pay the fee in fear and uncertainty, but paying it is what keeps you in the park for the long haul.
Okay, Section 6, the unbreakable financial system.
So how do we actually execute all of this? How do we build a system so ruthlessly boring that it practically guarantees we achieve quiet wealth and make it past that crucial decade mark? First, you must fundamentally alter your cash flow by paying yourself first. Second, you automatically route a percentage of your paycheck directly into low-cost index funds the very second you get paid. Third, by automating this, you dollar-cost average. You're buying the entire haystack on permanent autopilot, which completely removes human emotion from the equation. And finally, when everyone else is out there panicking over the news, your system just quietly buys more shares at a massive discount, allowing you to simply hold and wait out the decade.
If you can just ignore the apocalyptic news and keep your expenses low, you will eventually hit year 10. It is the magical threshold. At that point, the snow from the previous years has packed down and hardened. Your compounding engine officially takes over, and the returns on your investments actually begin to dwarf the physical cash you are contributing out of pocket. It creates a self-sustaining avalanche of wealth, ultimately buying you the highest dividend money can possibly pay. Absolute freedom over your time. As we wrap up this explainer, I really want to leave you with the provocative thought to chew on. Stop comparing your behind-the-scenes financial reality to the highlight reel illusions on the internet. Stop trying to find the needle and just buy the haystack. It's time to start embracing the brutal, undeniable math of an unbreakable financial fortress. So figure out the exact date you will cross your 10-year threshold and achieve your quiet riches. Thanks for joining me, and keep compounding.